Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, big inflation report came out recently for the month of January, was higher than expected and could lead to the Fed pausing longer, perhaps till this summer. Now, consumer spending has been strong, and we're not seeing the pain from consumers from higher rates. Let's discuss why. And then finally, despite that, credit card delinquencies are low, but have doubled over the past couple of years. Now, US CPI in January could lead the Fed to pause longer. US CPI rose plus 0.3% month over month. If you look at it year over year, it was 3.1%. If you look at core, right, that's removing the more volatile parts of the inflation report, ex food and energy, that core month to month was 0.4%. You can see on the chart, that's the highest since early summer 2023. Now, why is this important? Well, unemployment is still very low. Any kind of evidence that inflation perhaps could be sticky or rising, like we saw in January, has shifted the odds of the Fed cutting as early as March all the way back to the summer. So the Fed has been pretty consistent in their narrative during the past few weeks. And this news is only supporting that narrative that they're going to be more patient. We're seeing the odds of a rate cut get pushed out a little bit. And you saw rates jump up higher as the higher for longer narrative is starting to enter the market here as we near the end of the middle of the first quarter. Now, unemployment's low. Consumers are not feeling the pain of higher rates, right? With a strong labor market, if you look at consumer debt outstanding on this table here, you can see household mortgage debt, student loans, and auto loans. When you sum those all together, that sums up to 89% of total US consumer debt are going to be fixed rate debt. So they had interest rates locked in, perhaps low, during that low interest rate environment. And even though the Fed funds rate is near multi-decade highs, consumers are not feeling that pain because they've locked it in, especially with mortgage loans. Now, we've seen that in terms of consumer delinquencies. If you look at credit card delinquencies, that are outstanding credit card payments that are more than 30 days late. It's been relatively low during the past couple of years, but it reached a low back at the beginning of 2022 of 1.5%. It is rising. It's at its highest level now in more than a decade at 3%. So it has doubled. So it's still relatively low. It's not spiking, but that's something to keep an eye on, is that consumer spending's been strong. We're starting to see an increase in delinquencies. Is this something that could start to rear its head if we start to see any kind of pullback in terms of the labor market? These are types of measures that you want to monitor. But so far, with inflation still high, with unemployment still relatively low compared to history, the Fed is likely to pause till the summer, but we're starting to see some little cracks here on the fringes. Now, outside of the markets, an Oklahoma judge during a murder trial was caught sending more than 500 text messages while presiding over the murder trial. So during those messages, they found them. They were mocking prosecutors, included emojis. She resigned from the bench. The quote that she had was that she promised to uphold the Constitution, even-handed and an efficient manner. She said that she believes she has still done so, but however, being human, she has faltered slightly. Well, that's debatable about how much she faltered, but that mistake cost her. Obviously, she had to resign from the bench. It's unfortunate for her, but lesson to those that want to become a judge, you should pay attention and not be texting. Perhaps put the phone away if you're presiding over a murder trial. So with that, I want to thank everyone for watching, and I'll see you next time.